Target costing is a market-driven approach to pricing that looks to calculate an acceptable level of costs based on a selling price that has been researched in the external market. Let's consider the steps involved for a typical manufacturing company in the target costing process. In a manufacturing company, target costing applies to a particular product. So we begin in step 1 by specifying a product that the company wishes to sell. This will involve an analysis of the market and a determination of what product features are of interest to customers. In step 2, the price at which the product will be sold is considered. This will be a market-driven price based on what a customer is willing to pay for the product or their perceived value of that product. This is referred to as the target price. The company then calculates the profit that is required from the sale of this product. This profit is usually determined by what the company investors may deem to be an acceptable return on their investment. This can be referred to as the required profit or the target profit. In step 4, we determine the target cost. This is calculated by subtracting the required profit, as we've discussed in step 3, from the product selling price, as we saw in step 2. The target cost represents the highest acceptable cost of the product. If the estimated costs of that same product are greater than the target cost, then a cost gap exists. This cost gap needs to be closed, meaning a review of the costs incurred during the product's design and production stages. It is important, however, that the quality of the product is not impaired as a result of any cost reductions. Finally, in step 6, if a cost gap still exists, the company could consider negotiating with customers in order to determine whether the manufacture of the product proceeds. Let's see the target costing process in action by way of an example. Company A has calculated a selling price for a new product, product P, of $100. A profit margin of 30% is required to satisfy the company investors. The question is, calculate the target cost. We now know that the sales price minus the profit or the required profit is equal to the cost or the target cost. Company A has established a selling price of $100. We can assume that significant market research has been undertaken to ensure that this product P is of interest to customers. Also, we can assume the price of $100 is competitive and has been set based on what a customer may be willing to pay for this product, as well as the desired share of the market sought by Company A. In other words, we can say that the $100 sales price is a target price. A profit margin is calculated based on what it is an acceptable return to Company A's investors. A 30% required profit margin equates to a $30 profit based on product P's sales price of $100. Based on these numbers, we can derive the target cost of the new product. This is calculated by subtracting the required profit of $30 from the product selling price of $100. The target cost of $70 represents the highest acceptable cost to Company A of making product P. Now let's continue with the same scenario involving Company A. Company A calculates that material, labor and overhead costs associated with producing product P are $40, $25 and $13 respectively. Calculate any cost gap that may exist regarding product P. The total estimated cost of making product P amounts to $78, being the sum of 40, 25 and 13. This estimated cost of 78 exceeds the maximum allowable cost or target cost of $70 by $8. This $8 is referred to as a cost gap or a target gap. Company A must focus on reducing or eliminating the cost gap. In other words, the anticipated material, labor and overhead costs incurred during the design and production of product P must be revisited to see if any cost reductions can be made. It's important that in its effort to reduce costs, Company A does not sacrifice the quality of the product. Any impairment of quality could have a knock-on impact on customer demand and ultimately company profit. Value engineering is a term often associated with target costing at this stage of the process. Value engineering helps businesses achieve cost efficiencies and meet their cost and profitability targets. Attention therefore should be focused more on reducing the cost of product features perceived by the customer as non-value adding. To eliminate the cost gap, a company could consider alternative product designs. It can often be easier to reduce costs at the design stage of a product than during its production stage. If a company is looking for possible areas of cost reduction during the manufacturing or production stage, then the following may be considered. Can any of the materials be eliminated? Perhaps, for example, the product packaging could be reduced. Can an alternative, cheaper material be substituted into production? Care must be taken here that a cheaper material does not impact the quality of the product. Can the cost of labour be reduced? Maybe it is possible to use lower skilled labour, thus paying a reduced amount. Again, quality should not be compromised here. Staff morale could be improved, which might have positive implications for productivity. Automation. It may be possible to replace repetitive labour tasks with machinery. Over time, this could result in cost savings. Or perhaps the incidence of cost drivers could be reduced, thus reducing any overheads incurred during production. These are just some possible actions a manufacturing company could consider when looking to eliminate a cost gap. Note that it is not possible to close the cost gap by increasing the selling price or reducing the profit of the product. The sales price and the required profit have already been determined by reference to factors external to the company. Target costing is just as relevant to the service sector as it is to the manufacturing sector. However, problems can arise when trying to apply target costing in service industries. Unlike manufacturing, service industries have the following characteristics which can make target costing more difficult to implement. Spontaneity. Unlike manufactured goods, a service is consumed at the exact same time that it is produced or made available. Or in other words, the service does not exist until the point where it is experienced by the customer. Perishability. Because the service is consumed immediately, then it is perishable. Hence, unlike a manufactured good, a service cannot be stored or placed in inventory. Intangible. A service cannot be seen or touched, hence it is intangible. This obviously differs to a manufactured product, which has physical substance and can be seen and touched. Unique. As a service involves people and typically human interaction, then no two services can ever be seen to be homogeneous. While standardization of a service may be expected by the customer, this is often very difficult to provide. And finally, no transfer of ownership. Unlike manufactured goods, services do not result in the transfer of property. The purchase of a service only grants the customer access to or the right to use a facility.